if I told you that in retirement you could have guaranteed income, market upside potential, and more age pension? Now, you'd probably be thinking that that all sounds pretty darn good, and it actually is all possible, but of course, there is no light without dark, there is no hot without cold, and in the world of finance, there are no pros without cons. So in this video, I am going to break it down, walk you through exactly how it works, the potential benefits, and the factors that you need to consider. A way to get guaranteed income plus market upside potential plus more age pension would be through using what's called an investment-linked lifetime annuity, which is a type of innovative retirement income stream. Now, annuities aren't anything new. They've been around for many, many years, but investment-linked annuities, they are relatively new on the scene here in Australia. The way it works is that you buy yourself an investment-linked lifetime annuity, which is essentially like purchasing yourself an income stream for life. You are swapping your capital for income. And as the name suggests, an investment-linked annuity is invested and you actually get to pick the underlying investments based on your risk tolerance. Now, the payments you receive every year from this annuity, they're gonna vary depending on how the underlying investments perform. But importantly, there will always be some level of income provided no matter how long you live. This is essentially like entering into a contract with a life insurer. The provider, who is the insurer, well, they price payments based on the average life expectancy. So it's a bit of a gamble against the insurer. If you live longer than expected, you win. If you pass away earlier, well, then the insurer wins and your estate essentially doesn't. So don't be thinking that this is a good idea if no one in your family has ever made it past 70. Now, I won't go into all of the nitty gritty about how these things operate, as I want to get into the meat of this video. But if you are interested to learn a little bit more, I'm going to put a link to my strategy library article in the description box below, which you can go to and learn a lot about how they work. There are 3 key ways that you win by utilizing these investment-linked lifetime annuities. Now, the first one is, of course, guaranteed income for life. So even though payments, they're gonna fluctuate based on the performance of the underlying investments, you will always receive some level of income. Secondly, we have the Centrelink advantages. So with a lifetime annuity, only 60% of the purchase price is counted under the assets test until the threshold day, which is currently age 85 or 5 years from the start date, whichever is later. After that point, only 30% is counted. So if you're over that minimum threshold for the full age pension, or even if you're above the upper cutoff limit, this strategy could get you more or some age pension, provided you are being assessed under the asset test and not the income test. And 3 is market exposure. So you are maintaining exposure to growth potential and inflation protection through these investment-linked returns. Now, given that you're potentially retired for 30 years or more, this can be very beneficial because if history is anything to go by, then you should receive significantly higher cumulative income over the medium to long term by having this market exposure in your annuity. But of course, you need to weigh up those benefits with the potential downsides, and the key downsides, well, the first one is that there's a fluctuating level of income. Down markets are going to mean lower payments. Second, there is limited access to capital. So once invested, the funds are locked into that annuity. Now, many providers do offer withdrawal windows in the early years. However, this would likely lead to a higher than otherwise loss of capital. They're designed to stay in there. And thirdly, there's a potential reduced estate value. So your estate may receive less than if you'd retained the capital and invested it independently. And unfortunately, your estate will receive nothing if you pass away beyond the death benefit period. Now, this downside can arguably be offset by the reduced need to draw down on assets outside of the annuity, because thanks to the annuity, you could potentially get more age pension and, depending on how you structure the annuity, higher upfront payments. I personally would never put all of my retirement nest egg into an annuity because you should never be too quick to give up your capital. It's your capital, that access to money, that gives you options in life. From an investment perspective, these annuities, they're not doing anything special. They're just taking your capital and investing it and giving you some of that back every single year. You can do this yourself without the extra layer of fees. However, there are two things that you can't do yourself. One, you can't guarantee yourself income for life, particularly if you live a long time. And two, you can't increase your age pension entitlement without getting rid of some of your assets. Now, the life insurance type aspect of these products does mean that if you live longer than the average person, you are likely going to get back more than if you just invested the money yourself. However, no matter how healthy you are, the future unfortunately is never guaranteed. You could exercise every day, eat healthy, avoid alcohol and smoking, and still get hit by a bus. So I typically don't base the recommendation on longevity, although you could if that was important to you. However, there is this sweet spot where I think these investment-linked annuities can be very beneficial, and that is when it gives you the additional age pension. Getting additional age pension is essentially like a risk-free component to this strategy. You aren't relying on investment returns to get more income, you are getting it from the government based on the current rules. Now, of course, you can get this benefit from a traditional lifetime annuity as well, but unless you're ultra conservative, I think maintaining a well-balanced level of growth exposure in retirement is really important to generate that real return you need above inflation. Now, if you're already under the threshold for the maximum age pension, I personally wouldn't bother with an annuity. Likewise, if you're significantly above the maximum threshold for the age pension, I probably also wouldn't bother with an annuity. But there is this sweet spot in the middle where it becomes this great little income diversifier as part of a well-rounded retirement strategy. But that's it for me today, guys. Thanks a lot for watching. If you like this video, please give it a thumbs up and I will see you guys in the next one.